its conclusion. Enjoy!
Because there's going to be some last-minute changes.
Here comes some more
A lot of last-minute changes, and no dancing to the music. The first problem that I was down in Washington, one of the first problems we're going to have, and this was amongst the practitioners, how are we going to charge? You're not going to charge by the page. You're not going to charge by the hour. You're going to have to charge with value billing because we are going to be advisors. The way this law is, the one employee firm or the 500 employee firm has to establish the benefit year, and it can begin October 29th or it can begin when the person tells you. There is a form on the DOL website where the employee says, my year begins tomorrow or whatever the date it is. And you accrue an hour for every 30 hours worked. You must have your client keep track of the hours that a person is working. That goes for a part-timer, full-timer, it doesn't matter unless they're union people. Union people are exempt. Size of the firm has no bearing.
Is this something the payroll companies are doing?
Excuse me?
Is this something the payroll companies
they
are on
offered
top
it.
of, or no?
I'm sorry, I have a...
I gotta think.
Yes,
it
they
what?
can. They can.
The governor signed a bill in May.
She's asking about
She's
the payroll.
asking
She said,
if-
the payroll services do it.
Yeah, they
The
are.
payroll service, they'll do it,
They'll do it for
but, not everybody has a payroll service. Some practitioners, including myself, I have 4 clients that have 1 employee. They're not going to pay the, ADP or anybody else $3,000 a year, except that I'm going to be telling them to do that because, to be honest, issuing W-2s is a pain in the butt. Speaking of W-2s and 1099 MISC, if you look at the instructions issued yesterday by the Internal Revenue Service, number 1, it says they recommend you file the 1099 miscellaneous by January 31st. So I wrote them this morning. I said, what the heck is this recommend? Two months ago, you sent out a bulletin telling us there's no extensions for W-2 or 1099 miscellaneous. If you don't give an extension, I think that means you want us to file it. So I'm waiting for an answer. The instructions read recommend. So I went back to the 17 instructions and it says you got to file unless you get an extension by January 31st. How many days are in January? 31, right? You're an accountant. Come on, you know that.
Still is, unless they change the
You can't do this work in 31 days. We don't get bank statements till 15th. They give you 16 days. Let's be practical. Let's be honest. But that's what the story is. There's no extension. Now, I will tell you this. There are 2 or 3 things the IRS has already pre-programmed into their computers. If they see a person's return, where last year they had employee business expenses and a high W-2, and this year they see a lower W-2 with a Schedule C, they're going to get a letter from the IRS. If the client all of a sudden has very little entertainment and a lot of advertising, they're going to get a letter. The government says, we know all the tricks and outs and ins. Okay, so anybody wants to play the game, I'm just letting you know in advance, they're looking for it. So in Jersey, also there was a marketplace sales tax change, I guess in coordination with Mayfair, whatever it is. Ride-sharing services, be very careful with clients who conveniently forget that they did that kind of income. Now, also, on the New Jersey return, they're allowing $15,000 for real estate taxes. The number that goes on page 2 of the 1040 in New Jersey comes from the bill that the client received, not the blue card. The bill that they received in August states 2018 real estate taxes. That's the number. Whether it's paid or not, the state of New Jersey doesn't care. That's the number that they're going to be matching. You don't match the number, you're going to get a letter. Next, EITC has been increased on the federal side. It's been increased on the state of New Jersey side. Also, Form 8867, due diligence. The penalty has been increased to inflation, and you are responsible if you have head of household, AOTC, EITC, and IOTA or whatever it is. Okay, the form goes with the return, and if you forget it and you use head of household, $520 penalty, and it may be raised due to inflation, which just came out yesterday. The child tax credit is $2,000. There's another one for $500. You have to list the child, even though he can't get the dependency, but you must list the child on the return, otherwise you don't have due diligence. The family sick leave. Let's see if I think I had the form. So meals, be careful with meals and entertainment. What brought it out was somebody pays $100,000 for a skybox over at the Meadowlands, and it's not deductible. So one of the people in the audience raises his hand and says, "What happens when we put a flag with our name on it? We're advertising." He said, "We're looking for you." So I just want you to know they haven't fallen asleep yet. They're working on it. There are many changes to the pension plans that was released yesterday. Depreciation, the 100% write-off is available, but you have to look at 179 very carefully and determine which is going to be the best for your client, because the 179 is recaptured. The definition of qualifying relative, as soon as they build a fence in Mexico, that may change, so we don't know. I'm making fun, but it's not fun when you have to sit down and decide if a person qualifies you for head of household or some other category. Home equity loans, some of the banks have recast them, but if it's not on a house, you're not getting it. Okay? The other thing to watch out for is business interest. It's limited to 30%. Okay, and the rest of you got to carry forward, I believe. You're going to have to really look at the 1099 or 1098 form, I guess, that'll be coming out. I don't know. There's some changes that have to be looked at. You have to look very carefully into W-2s. As you know, New York allows you to itemize. They said TCJA, the heck with them, we don't want it. So New York said you can itemize. I haven't seen any tax programs with advanced filling out forms as of yet. So, and New Jersey says, we'll give you $15,000, but it's going to be based upon that figure that comes from the tax bill. So make sure you clients bring in the tax bill, not the blue card. The blue card does not have the correct number.
Howard,
Yeah.
go back to the home equity loans? Because this morning I saw something come through on the listserv where.
You saw two partners in the same firm who don't talk to each other.
Apparently, because I was under the impression that if it's a home equity.
I hope you don't go to work for that firm.
I thought that was just completely gone. You can't, it's not like.
No,
something
it's not,
big
it's not
grandfathered
gone. Home equity loans are still good if it's
On the house.
on the house, but not for student loans,
Right, so there's no grandfathering in or something.
not for
that-
student loans.
Right,
Because the bank isn't gonna give you a mortgage interest statement.
yeah, but that was not what was on, that was not the
gotta trace
response
the
that
money.
was on.
Yeah, but
this morning.
I
That's
just,
why I'm
I'm glad
asking
you
for
saw,
clarification.
I'm glad you saw what I saw this morning, because
Yeah.
I know they're both individuals, and I'm trying to figure out, they have a desk 15 feet from each other. Why are they answering each other's question?
Because one was dictated from the car. Did you see that? The response
Yeah,
was
actually,
dictated
it
from
was.
the car.
You're right.
He wasn't in the office.
You mean the
Yeah.
car
Yeah.
answers? What is it, like,
Well,
There
because
were some
it-
funny
wrong
typos in there.
Yeah, there were
The only
different
one where
versions.
you right
of
answer.
it.
Yes, you're right.
That's it. Oh my God.
what is it, like Knight Rider?
I mean, look, I answer 99% of the questions that are on Connect, but you haven't seen my name because I've been answering them offline,
Yeah.
calling the people or sending them an article. I don't want to embarrass anybody, but this particular case this morning, I was rolling. I mean, I can't believe these people. Okay, two people in the same firm. Hello, I got a question. Oh, okay. The other area to watch is charitable contributions. High on the hit list is non-cash contributions. And all the games with the workarounds and so on, none are recognized by the IRS. So don't play the game, you're only gonna get into trouble. Now, the other game that people are gonna play is, they're gonna tell you that the real estate taxes is gonna be paid by my business, and therefore I can deduct it. You cannot deduct it on a business unless it pertains to that particular business venue, period. Okay? This tax law has at least 200 workarounds that people have been suggesting for the last 5 or 6 months. None of them have been accepted by the Internal Revenue Service. Now, we know they're shorthanded. They were just given permission to hire 300 people, 300 pieces spread across the United States. That doesn't add up to a hill of beans. We don't know what's going to happen, but I tell you this, when our clients receive a letter that says Internal Revenue in the left-hand corner, they shake in their pants. We don't have Exxon, for the most part. Barry, your firm is different. No, we don't have Exxon. We don't have the real big guys. They don't care. But you are handling people that for the first time, you have to tell them, we can't itemize this year. Your dependents won't mean anything. Your miscellaneous itemized deductions are gone. Your mortgage interest is limited. Your medical deduction, by the way, is 7.5% this year, not 10%, as it was supposed to be. The charitable contributions, non-cash contributions, there have been 5 cases in the last several months that got knocked out and down to $250, period. Because there's no 82, 83, number one. There's a lot of other problems. Some guy tried to pass off $18,000, he said, but they were under $500 each one, and I don't, and he's trying to pinpoint the law. He lost in tax court. And by the way, Wesley Snipes also lost. He did an offer in compromise, and the government says, no way. So he's going to jail. Good actor, but he's going to jail. I'm sure we're going to all bleed for him. That's about it. But again, if you sit down and do some, look at, you got some high rollers. Everybody has a few. I'm not concerned with 199 because 199, if you're under 315,000, which goes for about 90% of the clientele, that we're talking about, you have no problem. The only place you will have a problem is the small renter, because 162 does not seem to elevate that particular source of income. Because I will tell you, if the 162 for the small renter were to be elevated to allowable business, remember 2 years ago, they came out and said you had to issue a 1099 to the plumber and the guy that does your sidewalk that you've been paying cash under the table and all of this. If you go into 162, that's one of the requirements, that you issue the 1099s. We're gonna have another revolt, and the IRS can't handle it. They can't handle the paperwork from the 1099s. So it's not gonna happen. Yes?
Question. Has anybody seen the trend of the small C corporation with $50,000 or less of taxable income that was benefited by a 40% increase in their taxes because of these 21 across the board for everybody, converting to take advantage of the 199? Or else they're paying 40% more taxes if they're taxable income. And I've heard virtually nobody talking about this. And to me, it's incredible oversight when they wrote this legislation.
199.
It wasn't an oversight. It wasn't an oversight.
Well,
That's how they're making part of the money back from decreasing the rate down.
I don't want to, believe me, you don't want me get me started on that issue, okay?
I know.
You don't want to hear, no, some people in the room might be offended, but at any rate, yes, all I'll say is yes. But the bottom line is, the small C corporation got benefited by a 40% increase in their taxes. Outrageous and totally unnecessary.
My client would,
But are some of them
only be
converting-
paid 15%.
Converting to, theoretically, I guess if you convert, if your taxable income is low, you convert and then you can take advantage of the
Well,
199.
basically, you could
My
go from
suggestion-
21%.
Yeah, but that costs money to convert too. You know,
You
My
can go from
suggestion to
21% a
people-
22%, but you'll have the
outrageous
deduction.
is what it is. And nobody's talking about it. Nobody talks about it. It's incredible.
Well, the only one that benefited was the people that were paying 35% flat,
Yeah, sure they were. Yeah.
right?
Yeah, with
And
their effective
39%.
tax rates of set between 15 and 20%.
Let me,
BS.
There's-
Sorry,
there's-
pardon the expression.
I would venture to say,
I know, level playing field now.
I would venture to say there's a large group
Yeah.
who did not benefit.
You think?
Well, I mean, after
Okay,
all our
now-
corporations have been losing money in this country until they change
All
that
right,
tax
let
rate.
me, people have called me up and said, should I convert to an S, should I can do this? My answer, my standard answer has been, wait until the smoke clears, and right now it's foggy,
Well, it's
at best.
something worse than that.
They're gonna get hurt this year.
I can't use that language, Andy.
Why you gotta convert? Sole proprietors, everybody's eligible for 199.
Yes,
But not a C
Not a C
corp.
What if you're a C corporation? Your taxable
C
income
corp
went
at
up by
21
40%.
instead of 30%. Okay.
90% of our clients are LLC.
Fine,
or-
fine, fine.
What's
But
that?
there's no such thing as a C corporation with taxable income under 50,000. I think there's a few of them around.
Because the tax law was for the middle class.
Of course.
Believe me.
And don't forget, all the middle class, the cutoff for
bill was not
39% is
written for us.
450,000. That's middle class, right? They lowered by 2
Yes, sir.
For 199 for a small company, some of the people, like professionals, could you use a defined benefit plan to get under the 415?
Yes,
Okay.
yes. The only opening in the whole situation,
Repeat for our people on the, our eye in the sky there?
oh,
Yeah,
Just
what
repeat
your
the
was.
question.
the question is, for the small corporation, what was it?
Well, an LLC with 1 or 2 people, 3 people.
Yeah,
Defined benefit.
To get
the
under
defined benefit, the only opening that I have seen publicly being made is increase your pension contribution and get you down below the 315. That's the only suggestion that I have seen that will fly. There's no other item on your P&L that will flow as well as a pension, and the client will benefit. That's been the suggestion for several months, from coming from everybody. There is no other alternative. The rest of the stuff is game playing. Okay, and if you have clients like I do, who worry about the $25 discredit and the real estate rebate from the state of New Jersey, which is just coming out, if they're worried about that, they're not even concerned with Schedule A. How many people have had a meeting with their top clients about the TCJA? Look at this, no hands. 2 hands, okay? 3, 4. And you know, we represent a lot of chapters, we represent a lot of people in this room, and there's very little that's being done. Your clients are going to get an organizer, hopefully, and make sure you have an engagement letter, okay? They're going to get an organizer, they're going to fill it out. I looked at some of the organizers, it has cautions on every page, and your client's going to say, my accountant will take care of it.
Yeah.
Just buy insurance, that's all I can tell you.
One other quick thing, Howard.
Yes, sir.
The use for people, obviously, if you have hair my color, you can think about it, but contributions out of your IRA, a way to...
That's still open.
Yeah, I know that, that's what I mean.
They haven't touched that
Legit-
yet.
No, I know that,
But it's a benefit.
Yeah.
It's a benefit for those over 70 and a half.
Absolutely.
It's permanent. It's permanent.
No, I know that. It's something
And
that
should be taken
some
advantage
people
of where you can.
Particularly if they don't have very large deductions, itemized deductions, and obviously 10,000 limit on a tax. So let's say they don't have a whole lot of interest, and the only other thing they have are contributions, they may be better off taking a standard deduction, okay?
Well, I
That's
have
what
a
I'm gonna
client,
do.
that
And
makes
then
a
take the contributions
contribution.
of significance out of their IRA, and they get the benefit for it off the top.
My
So they get-
my
they have
client
their
makes
cake- they have their cake and eat it
25,000 in
too.
contributions,
Yeah,
okay?
do it out of their...
I've got a problem.
If they can, do it out of their IRA.
So I get 25 and 10 is 35.
Absolutely.
Okay, it's not a problem.
It's perfectly legal.
Thank you, I'm sorry. I'm sorry if I ran over, but it's not going to be an easy tax season. There are a million questions out there, and this astute group, who I am very fond of, okay, we're going to be at the forefront. So be careful, and just do a lot of reading, that's all I can tell you. Thank you.
Thank you, Howard.
Thanks for the good news.
All right, we have a couple of presentations this afternoon. First one is going to be Ron Palkowski. Am I close?
Close.
Okay, so Ron is going to talk to us about the taxation of insurance practice. He has his own life insurance practice. He graduated from Rutgers in accounting, and he actually worked in public accounting for 5 years. He's worked in the financial services industry for over 30 years, and is a CPA and a CLU, and he's been active in the New Jersey Society, and he's a veteran of the Green Group. So thank you for your service.
I hope you have good news, because
Perfectly legal.
I think he just went to sleep.
Actually, no, he's been doing that for years. What do you have? Just a year. Yeah. Well, I got a form from principal IRAs, I got a form to fill out.
Okay, Paul introduced me. Usually when they get speakers for this type of thing, they look for a prominent professional on a timely topic. They couldn't find anybody, so Paul asked me to address it today. I'm going to talk about life insurance. Granted, it's not the most, it's not the sexiest topic, but it is something that your clients look to you for. They look to you for advice. And how do I know that? And when I present a policy, oftentimes they'll say, well, Ron, let me run it by my CPA. So they're looking to you for guidance in this area. And there are some tax traps that you gotta know. If you're gonna give them good advice, you have to be aware of the tax traps. One of the biggest advantages of life insurance is its income tax-free nature, right? I mean, if you're doing any type of business plan or even in personal, the tax benefit is, the death benefit is tax-free.
Somebody's coming in.
Okay. The death benefit is tax-free. We're going to get the outline up there for you. To the extent that there's a tax burden associated with that death benefit, it uses utility, right? If it's tax-free, that's great, but if you've got to pay some taxes,
Tech support?
yeah, it's not working. It was up and then it just, I thought it went to sleep.
I didn't touch it.
You did, Howie, it was on until you got up there.
It's a revolt.
So, generally, the death benefit is income tax-free. There are a couple of situations that will make the death benefit taxable. You're going to want to avoid those. We'll go over them later. Of course, that's income tax-free. The total face amount is included in the owner's estate. Used to be a big deal. Now with the increase in the estate exemptions, thank you, not so big a deal.
That's owned by the insured.
Well, but again, if you own a $5 million policy and you get $5 million in other assets, it's no big deal. You're under the estate.
Yeah, but you could put it in an LLC, you could put it in a lot of things, partnerships and so forth, so take it away, take it out of the estate.
Of course, I'm saying it used to be a much bigger deal when the estate exemption was much lower. Now, with 11 million, you know, it doesn't affect as many people as it used to when it was, those of you old enough to remember, 625,000.
600.
The premium. Premium's not deductible. It's on a personal policy, the premium's not deductible. And on business policies, most times it's not deductible. There are a couple of instances where the business can deduct the life insurance premium. The first one is, let's see if we can work this. Guess not. Group term premiums, right? If a business pays the premiums on a group term policy to cover all their employees, they can deduct that as a business expense. The employee, it's tax-free to the employee up to $50,000. Once it's over 50, you know, you got 1099. The employee, this is from Pub 15B, the rates that you have to 1099 the employee. It's still a good deal for the employee. If you look at it, you'd much rather pay that, the tax on that, than go out and buy your own policy. It's still cheaper, so it's not like it's a bad deal. It's just not as good as the old days when, you know, you could get $500,000 a group term and not pay any tax on it. But it's still, in most cases, cheaper. Now, the interesting thing about group insurance is it's a great deal for those who aren't in good health. All right? For the healthiest people, group term insurance, you might be able to do better going out into the marketplace. But if you've got health issues where you may not be able to qualify for a standard or better policy, group insurance is terrific because the healthy in the group subsidize the non-healthy in the group. So for the non-healthy, there's no way they can go out and beat the group term. The healthy, they may be able to. All right, so that's the first instance where life insurance premiums are deductible by a business to group term. The second one is pension. Now, technically, the premium's not deductible. What you're getting the deduction for is the pension contribution. The fact that you happen to use a part of that contribution for life insurance, okay, but you're really getting the deduction for the full pension contribution, regardless of whether or not you buy life insurance with it. Now, the law does allow to buy life insurance they say it's got to be incidental to the primary purpose. That's the code language, incidental. Well, what is incidental? Well, they define it. In a defined contribution plan, premium's got to be less than 50% on a whole life policy and less than 25% on a term. And the code considers universal and variable life as term. All right, so they're subject to the 25%. On the DB plans, all right, it's got to be less than 50% of the contribution, or, I don't know how that, it has to satisfy the 100 to 1 rule. And the 100 to 1 rule just says that the death benefit cannot be greater than 100 times the anticipated monthly benefit. So in other words, if the DB plan is funding for a $5,000 a month benefit for this particular participant, the maximum that you could put in the plan, not the biggest policy would be $500,000 under the 100 to 1. All right? So it's either or. It's not, you don't have to satisfy both of them. It's either or. All right? And then the other thing about the pension, if you buy the insurance and the pension, we talked about the death benefit being 100% tax-free. In a pension plan, it doesn't work like that. The only thing that's tax-free is what's defined as the net amount at risk. So if you got a policy in the plan, it's got a $100,000 death benefit and $25,000 of cash value, $75,000 will be income tax-free. That's what the IRS says is at risk. The other $25,000 is going to be treated as a pension distribution. They're saying it's no different than the other assets that are in the pension plan, the cash value. So there's kind of a split treatment there of life insurance and pension plan. And then the last type of deduction you can get is the 162, the executive bonus, right? Where the business bonuses the premium to the employee or what have you. It was just in the news recently. University of Alabama did a 162 plan for Nick Saban. All right, and what that did is, yeah, he had to pick up the tax on the premium, but it allowed him to name the beneficiaries and for the beneficiaries to get the full death benefit. All right, whereas Michigan and Clemson, they structured theirs as a split dollar. All right, they also took out large insurance policies on their coaches, but they did it via split dollar. Now, what the split dollar did was they would advance the premium or the bulk of the premium, and they would be indemnified. They would get back their entire investment in the contract, either A, when the coach died, all right, or B, when the coach left the school. So there, the Clemson and Michigan coaches their beneficiaries aren't getting the full amount of the death benefit, but they're not picking up any of the tax. Alabama's coach, his beneficiaries get the full benefit, the full death benefit, but he's got to pay the tax on the premium. So it just depends on which way you want to go. Next part about taxation is dividends. That's an unfortunate term because they should call it something else. I don't know what, but it's not a dividend in the sense that you're all used to dividends. The IRS has said that a dividend on a life insurance policy is a return of premium. That means it's not taxable, right? If you get the dividend, you don't have to pay tax on it. Well, if you get a dividend from Exxon, you got to pay tax on it. But not so there. So it's a little confusing, the terminology. It's just a return of premium, and there wouldn't be any tax until the dividends exceeded the premiums that you paid. which on a whole life policy would happen probably 40, 45 years downstream. I don't have to worry about it right away, but downstream that will happen. And on the paid up additions, technically the dividends reduce your basis in the contract. Paid up additions, yeah, they do reduce it, but then you get an increase for reinvesting it. So it's technically a wash. So if you use the dividend to buy more insurance, it's a net tax wash. There's no tax ramification. Okay, cash value. How is cash value taxed? Well, it's not. Okay, the increase in cash value is not taxed, and that seems to be at issue every time they have a tax bill. They want to tax the increase in the cash value. And that's basically, in my opinion, because they don't understand what the cash value is. If they did, they wouldn't have the conversation. Notice they don't have the conversation about taxing the death benefit. Right? That's never on the table that, hey, we can raise money, we can start taxing life insurance, that'll bring in money into federal coffers. That's never on the table because they understand that's bad public policy. Right? America's underinsured the way it is. Now, they're not going to buy more insurance. The average person isn't going to say, well, gee, I was going to buy $1 million, but now, since I got to pay tax on it, maybe I should buy $1.25 million, all right, because my heirs aren't going to get the full $1 million. That's not going to happen. They're going to buy $1 million and they're going to get what's left over. So that's never on the table. Cash value, they always talk about increasing, about taxing the increase in cash value. And again, like I said, in my opinion, it's because they don't understand it. And to understand it, you have to understand why it exists. In other words, you've got dozens, if not scores, of types of insurance policies, right? You've got life insurance, you've got disability insurance, you've got homeowners insurance, health insurance, car insurance, all kinds of insurance. Only one has cash value. Why is that? Are they onto something that nobody is? Everybody else missing the boat? That can't be, right? Because some companies write more than one type of insurance, but yet only one has. Anybody? That's not a rhetorical question. Why does cash value exist? Nobody?
Excess premium.
Pardon me?
Excess premium.
Excess premium.
It's the investment portion of the life insurance.
The investment portion. That's what they say. That's really, I'll get into that later. That's really not right. But that's not why it exists. In other words, we're looking at why does life insurance have cash value?
In the future, you can borrow against it.
That's a true fact, but that's not why it exists.
Premium exceeds the cost of the insurance.
Again,
Insurance
a
company
true
wants the
statement,
extra
not
money so
why.
they can invest it to make profits.
Not why. All these things you're saying, they're all true. But that's not
That's
why it
what
exists.
it's
In other words,
left
why
after
isn't there
taxation.
cash value on your homeowner's insurance?
I don't know why.
Okay.
Somehow related to your life expectancy, is it?
Well, Andy's on the right track.
Yeah.
Every other type of insurance
Closer
we
to
mentioned
Yeah.
That's fun.
insures a potential event, right? You might be in a car accident, you might get sick and go to the hospital, your house may burn down. Life insurance, we're insuring a known event. Jim Morrison notwithstanding, nobody gets out of here alive, right? So we are insuring a known event.
Suppose you get to it.
And in addition to insuring a known event, with each day that passes, we're closer to that known event.
Oh, geez, why won't we sit here?
And then, also, with all the other types of insurance, you could have 0 claims, or you could have multiple claims. With life insurance, there's one. There's not 0, and there's not multiple, there's one. So with that, the actuaries construct
You don't believe in coming back, huh?
a policy. And the cash value, what you said is true, it increases. So what the cash value really is it's the reserve that the life insurance company is putting away to pay the claim. Because when you've got a whole life policy, the insurance company has to pay the claim. The only way that they don't have to pay the claim is if you cancel the policy. It's a unilateral contract. Remember back to the business law days. All the rights reside with you. So that's why the cash value exists. And there's two schools of thought. The people who want to tax it don't understand that it's really just the reserve that the insurance company's putting away out of a portion of the premium to ultimately pay that death claim. What they're saying is, hey, what's the difference between that and a savings account? A savings account goes up every year, and I get a 1099 from the bank, I got to pay tax on it, right? How come you don't have to pay tax on the increase in the life insurance? Well, you could also look at it, I got a mutual fund, or I got a stock that doesn't pay any dividends, and that value goes up. I don't have to pay tax on that, right? Not until I sell it. So why do you have to pay tax on it? So that's the debate that's always going on, yes, sir.
When you die, do you get both the face value of the policy and the cash value?
Okay, the question is, when you die, do you get the face value and the cash value?
No.
So there's nothing to tax.
No, you're getting back your money.
So there's nothing to
Not-
tax.
Yeah, if you
There's nothing to
reinvest it.
tax.
Cashing
There's
before.
there's no incremental value to you. You're only going to get the face value.
Well, the cash value is available to you while you're alive, and we're going to get into how you can access that. But when you die, there's a special way on variable and universal life. You can pick what's called option B so that you get both. Very expensive, and it's not a sustainable strategy, but you can pick that where you get the cash value and that. But on a whole life policy, no. That's just the reserve, and you get the death benefit.
It's sort of the present value of your eventual death.
Well, again,
In a sense, that's what it is.
the actuaries, again, these are
Based on your
pretty...
age and all that.
Yeah,
how far
these
along.
numbers don't lie. They didn't pick these numbers out of thin air, all right? If the policy, to your point, if the policy is surrendered, you're going to get the cash value. Now, is it taxable when you surrender? Well, that depends. If it's more than your basis, yes, you're going to pay tax on it. If it's less than your basis, then no. You're not going to get to deduct a loss. In other words, if you've paid $10,000 in premiums over the course of the policy, and you surrender it and you get a check for $15,000, you're going to pay tax on $5,000 ordinary income. It's not a capital gain. Life insurance policy is not a capital asset. You don't get capital gain treatment from it. If you paid $10,000 in premium over the course of the policy and you surrender it and you get a check for $7,000, you're going to owe no tax, but you're not going to get a write-off either. There's no loss on a personal policy. Loans, okay? Loans are not, again, another poor choice of words. I said dividends, it was poor. Loans is poor. That one I know what it should be called. That should be called a lien, because that's what it is. It's a lien on the death benefit. If it's a loan, it's the only loan I'm aware of that you don't need a job to get, right? You just fill out the piece of paperwork, give it to the insurance company, and they'll send you a check for whatever you request. They're not going to ask you for your employment. They're not going to ask you for your credit history. They're just going to send you the money. But they're going to attach it. And why are they going to do that? Because they've got the ultimate collateral, your life. All right? They're going to get that money back.
So they're the devil.
They're going to get their money back. You're either going to pay them back while you're alive, or they're going to deduct it from the proceeds when you die. There's no risk in that whatsoever. They don't need loan officers to investigate whether or not they should make that loan. All right? Again, if you die with a loan on the policy, it just gets deducted from the death benefit. You got a $100,000 death benefit, a $5,000 loan, your beneficiaries are going to get $95,000. Income tax free. Okay? Still no tax benefit associated with it. Let me know how I'm doing on time, Paul. Just make sure I don't. And loan interest, again, not deductible personally. It could be deductible in business on key person, if you meet all the requirements of a key person, can deduct interest on loans up to $50,000, but that's an aggregate. So it's not like you can say, like Howie said, they figured it out. They know the game. You couldn't take a key man policy on every single officer in the company and, then borrow $50,000 on every, no. They know that
Can't you
game.
trace the money?
Pardon me?
Can't you trace the money? In other words, if I took a loan against my policy,
Yeah.
and I took that money and I invested it, wouldn't I have investment interest expense?
Call Alex Trebek.
Well, yeah, but whatever you do with that is, you can go to Atlantic City, you can do whatever you want with it. It's your money. All
What I'm
right?
saying is you trace the use of the money. So some of it mightn't be deductible if you went out and bought a car.
Well, but that's not deductible as interest expense, okay? You're then, in other words, the interest that the insurance company is going to charge you on the loan,
Which I'm gonna pay the insurance company with a check.
or you're gonna let them take it out of the policy,
That's a different story.
okay? Either one. If you write it either way, if you pay them or if they deduct it, it's not deductible. Unless it's a key man policy for a company. But if it's your personal policy, you take out the loan, you use it to go invest in whatever, and then you pay the interest to the policy,
Yeah.
you're not gonna get a deduction.
No,
Really?
really.
No, it's personal. You're not gonna get a deduction.
You call Alex Trebek and you get it for $9.95 a month.
Yeah,
Good luck.
I think what he's talking about is the interest tracing rules.
It's the interest,
So
yeah.
if you take money out, you trace where the money went to, you may be able to. So if you take the money out, you borrow from your life insurance policy, and then you invest in stocks,
Right?
right?
I can deduct
So,
that.
and you have investment income, you could trace that to that and say that that's investment interest expense. I think that's the
You're-
question.
Exactly what I'm
Yes.
saying. Because that's
I
exactly
don't
what
think
I've done.
so.
I don't think so. I mean, I'll look that up. I don't think
you're
that's,
right.
I don't think that's.
No, I don't think
If
that
I
happened.
think under the tracing rules, I could do it.
Right.
Personal interest. That'd be tough.
Life insurance is a terrible planning tool unless you're gonna use it to pay off your debt, which is more than $8,507 a year now.
That's what she's
Uh,
Okay, the next thing, and this is something that's very important to CPAs, because again, like I said, it's
It's a gamble.
income tax, it's not a gamble. We already said.
You're gambling on your life, that's it.
No, I'm gonna die, Howie, there's no gamble, there's zero gamble,
Ron, you and I are okay.
all right? But the transfer for value rules is something that you should definitely be aware of. If you're advising your clients, a lot of times you're using insurance for estate planning, succession planning, all these different things, and sometimes policies start moving around, all right? Because objectives change. Well, if a policy changes, there's a chance that the death benefit will not be income tax free unless you comply with the sections of the code. Now, a transfer for value means that there is value exchange for the policy. Andy says, I'm going to surrender my policy. I say, Andy, don't surrender it. I'll buy it from you, all right? And he goes, well, I'm going to surrender it. It's got $25,000 of cash value. And I said, I'll give you 30. He goes, well, why wouldn't I do that? I'm going to get $5,000 more than the insurance company's going to. So I pay him that. Now, whatever the face amount is, when Andy dies, it's taxable to me. There was a transfer for value. That death benefit is no longer income tax free. Right? There are 5 exceptions to the transfer for value rule. I've been following along here. All right. So we said, if it's transferred for value, the proceeds are taxable to the extent they exceed your basis. So if I paid Andy $30,000 and it was a $100,000 policy, $30,000, I get paid $100,000 from the insurance company. $30,000 is tax-free. That's what I paid. That was my basis in the policy. $70,000 ordinary income. Well, it may not be ordinary. We'll get into that in a minute.
If you continue to pay the premium, though, that adds to your
That
basis.
will increase the basis. If that policy still had premiums due, let's say it was $1,000 a year, and I paid another 10 years premiums, you're absolutely correct. My basis would not only be the 30 that I gave Andy, but the 10,000 that I gave the insurance company, so my basis would then be 40. So the 5 exceptions are, I'm going to get to A last, okay, because that's a little tricky. Transfer the insured, that's always free. So if the policy is transferred to the insured, you are a employee, a key employee of a company, they've got a policy out on you, you leave the company, they go, Carl, do you want the policy? You go, yeah, I want the policy. Hey, well, we're not going to give it to you because it's got cash value. You're going to buy it from us, all right? So you buy it from them. Still, no transfer for value because it went to the insured. So that's one of the exceptions. You don't have to worry if the transfer goes from anybody else to the insured. That's an exception, not taxable. If it's transferred to the partner of the insured in a partnership, not taxable. Now what's interesting there, though, specifically, if it's transferred to a co-shareholder in a corporation, it's not exempt. It doesn't make any sense, but you know, the tax code doesn't always make logical sense. I'm sure that comes as a surprise to everybody in here, but it is if it's transferred to a partner of the insured. Transferred to a partnership in which the insured is a partner. Again, no transfer for value rule, or transferred to a corporation with the insured as shareholder officer. Those are exceptions. Now the first one, the transferor's basis. The way the code reads is, if the transferee's basis, the person who's getting the policy, if that is in whole or part determined by the transferor's basis, then that satisfies the exemption. Now, again, that's an arcane rule, and I was trying to think of how that might happen. And what I came up with is maybe if you're buying a policy with a loan on it and the insured's basis is greater than the loan, and you're somehow tying it in so that you're mentioning the transferor's basis, that that's what you're paying for. Supposedly that will make it. But transfer for value is a definite trap that you've got to be aware of when you're advising clients. And like I said, a lot of policies are used for not only estate planning, that's becoming less prevalent these days because of the high exemptions, but succession planning. Insurance is used a lot of times in succession planning. Okay, life settlement taxation. It's the TCJA really redid Rev Rule 29, 2009-13. That used to determine the taxation of the life settlement. Now, TCJA really simplified matters because Revenue Ruling 2009-13, they distinguished, they had different tax rules for a sale versus a surrender. When you think about it, it doesn't make any difference because technically a surrender is you're selling the policy back to the company. You know, they call it a surrender, but technically that's what you're doing. Rev Rule 2009-13 treated those two transactions differently. TCJA now says no, there's no distinction. Doesn't matter, a surrender, a sale, it's all going to be taxed the same way. And the way it's going to be taxed is pretty simple, all right? Basis, anything up to the basis, all right, is tax-free. Whatever you recover to your basis is tax-free. Whatever you recover to over the basis, but less than the cash value, that's ordinary income. And whatever you recover over the cash value, that's capital gains. So I'll give you an example. You got a policy, you've paid $20,000 in premiums, it's got $30,000 in cash value. Right? You surrender it, what happens? You get $10,000 ordinary income, right? Your basis you're getting back free, the 20 is your basis, you're gonna get that back free. The difference between the 20 and the 30, the cash value, you gotta pay tax, ordinary income. But if you go to a settlement company and the settlement company says, we'll give you $40,000 for that policy. Well, you say, well, why would I give it to the insurance company for 30 if you're gonna give me 40, right? I'm gonna take the 40. Same thing, $20,000 income tax free, that's your basis. Next 10,000, same thing, ordinary income. The last 10, the difference between the 30 and the 40 is capital gains. You will get capital gains treatment on that. All right, so that's 2009-13 has been substantially revised by TCJA. All right, exchanges. 1035 exchange, you're all familiar with 1031 exchanges. A 1035 exchange is the same thing that has applied to insurance policies. You can exchange, it allows for the deferral of the gain. You know, for whatever reason, your policy may not suit your current objectives. It was suitable when you bought it 10, 15 years ago. Now your objectives have changed. You want to get a new policy. Rather than surrender it, especially if there's a gain, you can exchange it and defer the gain. You can exchange a life policy for a life policy, an annuity for an annuity, and a life policy for an annuity. You cannot exchange an annuity for a life policy. That is prohibited. There is no 1035 treatment for that. And since 2009, there's been a provision where you can exchange a life policy for a long-term care policy. And, can't see it there, but the both policies must be on the same insured. You can't exchange a policy on partner A for a policy on partner B. It's got to be the same life. I'm exchanging a policy on my life for a new policy on my life. Okay? No changing around. There was a private letter ruling, though, that gave an exception. I don't know why it would work. I guess it could mathematically, but where the one policy was a survivorship policy. It insured a husband and wife. The wife died. The husband wanted to do a 1035 on exchange. Well, you could make a case both ways, right? The survivorship policy insured two lives, but now, since one was dead, the survivorship policy is only insuring one, so it is going from a policy insuring insured to the insured. So there was a public letter ruling that said that that type of exchange was permissible. All right, anybody familiar with 101J? I'm sure you've all, your business clients, you've got to comply with that, right? It was the old, came about as a result of Walmart buying policies on all its employees. Well, you can't do that anymore, right? You can, but you're going to have to jump through some hoops in order to do it. 101J applies to all policies written after August of 2006. And the death proceeds will remain income tax free provided two things happen. Provided, number one, that the policy is on an appropriate insured. We're going to get to that in a minute. And number two, that the disclosure requirements have been met. All right? So what is an appropriate individual? 101J defines what an appropriate individual is. It is the employee at any time during the previous 12 months. If that person was an employee at any time in the previous 12 months, meets this rule, the appropriate person. If the insured was a director of the corporation at the time the policy was written, appropriate person. If they were a highly compensated employee at the time the policy was issued, that qualifies. if the insured was among the highest paid 35% of employees at the time the policy was issued, if the death benefit was used to pay death benefits to the insured's heirs, or if the death benefit was used to purchase an equity interest in the corporation for the insured's heirs. So, any one of those six, don't have to comply with all of it, any one of the six gets you to be an appropriate person and you meet the first prong of the test. Now, to meet the second prong is the disclosure requirements. In addition to meeting any of those, you got to meet all of the disclosure requirements. Every disclosure requirement must be met. There's 5 of them, and if you don't meet all 5, the policy's death benefit is not going to be income tax free. All right? The employee must be notified in writing that the business intends to insure their life. They must be notified in writing of the maximum death benefit that the company plans to procure on them. They must be notified in writing that the company is going to be the death benefit, the beneficiary of the death benefit. They must give written consent to being insured, and they must give written consent to coverage continuing after they leave employment. Got to meet every single one of those. So any one of the first and all 5 of the second. That's what you have to do if you want business insurance to be deductible today. And in addition, I'm sure you're aware, the reporting requirement's 8925. You got to file it. If you've got a company that has insurance on any of its employees, you're supposed to be filing 8925 with that return every year. Gift. Obviously, you can give a life insurance policy to anybody, just as you can give a stock or bond or any asset that you own, you can give it. There are some rules, special rules that apply to life insurance, though, the most notable being the 3-year contemplation of death. All right? You can't be on your deathbed and say, oh, gee, I shouldn't be owning this $5 million policy, let me give it to my kid. All right? Not going to work. Got to live 3 years after the policy is transferred for it to be out of your estate. Can give it to an irrevocable life insurance trust for a minor beneficiary, provided the minor will eventually get the policy. And the valuing of the gift should be done, IRS Form 712. Anybody familiar with that form? Should have the insurance company. You really can't complete it yourself because you just don't know what it is. It asks you information that you're saying, how the heck would I know that? And you wouldn't. So the insurance company will complete the Form 712, but that's acceptable in terms of establishing the gift, what the gift is, the value of the gift. All right. Modified endowment contracts. TAMRA, 1988, created a new class of insurance policies. Remember back in the 80s, interest rates were double digits, right? Everybody was getting 12, 13%, T-bills were 15%, whatever. So the insurance company, somebody said they're evil, okay? But that may be true, but they're definitely creative, okay? They're not going to miss a trick in order to get your premiums. So they came up with these policies, single premium policies, right, where nobody cared about the death benefit. You put $100,000 in the policy, you got $105,000 death benefit. You go, how the heck is that a good deal? Well, maybe economically it isn't, but the policy's paying 11 or 12%. They're saying, I don't really care that I got a $5,000 death benefit. I care that I'm getting a 10 or 12% return that what? Tax-free. Well, not exactly tax-free, but certainly tax-deferred, right? And what else? Life insurance is taxed FIFO. First in, first out. So you put $100,000 in this single premium policy, it earns 10%. So you earn $10,000 and you say, gee, I think I'm going to take my $10,000 out. Taking it out tax-free, right? Because you're taking out your basis first. FIFO, first in, I put the 100 in first, so until I take 10 years of that out, I don't pay any tax. Well, the IRS didn't take them long to catch on to that one. And they came up with Code Section 7702 and said, okay, we got this new class of life insurance policies called MECs, Modified Endowment Contracts. We'll get into it in a minute, but just remember that once a policy is determined to be a MEC, it is always a MEC. There's nothing you can do to make it not a MEC. It's the scarlet letter, right? It's got the M. It's a MEC. That's it. Now, it's also important to notice that just because it's a MEC, that doesn't change the cash value, okay? The cash value will continue to increase. You will not be required to pay any tax on the increase. And the death benefit, if you die, the death benefit's still 100% tax-free. So the MEC doesn't change that. What it does change is the access to the cash. And it kind of treats it much more like the code treats an annuity. So now, whereas I just said, prior to TAMRA, life insurance was taxed FIFO, it still is, but now if it's a MEC, it's taxed LIFO. All right, so just like that, the IRS got around saying, we don't have to worry about you doing that anymore because now it's last in, first out. So you want to take out the $10,000, great. You pay tax on ordinary income because that was the last amount credited to your return. All right, so that's the one thing they did. They also said that if you're pre-59 and a half, you're going to pay 10% penalty on taking that out. All right. There are some exceptions to the 10% penalty. If they're after 59 and a half as a result of disability or part of a series of equal distributions, excuse me, you can avoid the 10% penalty. Yes?
When you say the distributions are treated as ordinary income because they're on a LIFO basis, but still you would have basis, no?
You would have basis, but you're not getting your basis out first. You're taking the income out first. Whereas prior to TAMRA, it was taxed FIFO, so you got to take out your basis first. And until you took out all your basis, you wouldn't be subject to any tax. What TAMRA did is it flipped that and said, okay, now you're taking out whatever, your first distribution is going to be earnings. You still got basis,
but wouldn't I have to offset the earnings, the increase in the value up to the point of the earnings that are paid out?
You got 100,000. You put 100,000 in.
Yeah, right.
You credited 10%, so you got $10,000.
Right.
Now you got 110.
Correct.
Pre-TAMRA, you could take out the $10,000 income tax free because it's considered basis. Post-TAMRA, they're saying no. You got to take out your earnings first.
Yeah, but that 10,000 is a result of earnings, isn't it?
It is, and that's
so therefore, when I take it out, it seems to me I'm washing one to the other.
No.
But that 10,000 got added to my basis.
Yeah, but you didn't pay tax on it, what got added to your basis?
It didn't get added to your basis because you didn't pay tax on it. How does it get added to your basis? It gets added to your account.
It got added to my basis by virtue of the fact that it was added on to my whatever I would have gotten out. Right?
But you didn't pay tax on it, so you can't increase your basis.
Or the other way, I don't pay tax. If I get it under the old way, if I would have gotten it $10,000 right on the FIFO through a dividend, right? I wouldn't pay tax on the dividend necessarily.
Because FIFO. Now, if it's LIFO, in other words, you've got.
Yeah, but you're saying.
You got $100,000.
That 10,000 got added to my account over a period of time.
We're going to say it got added at the end of the first year. We're just making things easy. It was a 10%. So you got 10%, so you got a $10,000 $10,000 of interest, dividend, whatever you got, this is year one. So now you've got 110. Pre-TAMRA, they're saying you take out the 10, it's coming out of your basis. It's FIFO, first in, first out. Post-TAMRA, they're saying, no, no, no. Whatever's credit, you're taking out the earnings first. So post-TAMRA, pre-TAMRA, you take out $20,000. There's no tax, right? Because you're taking the 20 out of the basis.
Right.
Now if you take out the 20, you're going to have 10 of income and 10 of no income, and return of basis.
I got it.
Does that make sense? Okay. All right, so we talked about 1035 exchange. If you exchange a MEC for another policy, the new policy is still a MEC. You can't shake that. That MEC just goes with it wherever it goes. What determines a MEC? There's a thing called the 7-pay test. What the 7-pay test is what is the amount of a premium that you could pay every year for 7 years that would make the policy paid up. If it's more than that, it's a MEC. If it's not a MEC. Now, a paid up policy is a technical definition. A lot of people I talk to them, well, what are you paying on your policy? I'm not paying anything, it's paid up. Okay, well, what they probably mean is that it requires no more premiums. That's not a paid up policy, just because it requires no more premiums. It might, again, require premiums if economic circumstances change. Right now, it doesn't. A paid up policy is a policy that not only doesn't require any more premiums, it can't accept any more premiums. You can't put any more money into it if you wanted to. It's done. It'll still continue to grow. It still has a death benefit, still stays in force. It's paid up. So if the actuaries compute the premiums, as long as it's more than 7 to pay up the policy, the initial death benefit, it's not a MAC. If it's less, it's a MAC. And again, what happens is the new policies are so flexible. Agents, the actuaries design the basic policy, but agents can design an individual policy for a person. So they can either inadvertently or on purpose make the policy a MAC. Again, there's nothing necessarily bad about a MAC. Better to have a policy not a MAC than a MAC, but there's nothing inherently bad about it. The Goodman case, another tax trap. Everybody familiar with the Goodman case? Says that you've got 3 parties to an insurance policy. You've got the owner, you've got the insured, you've got the beneficiary. It's 3 different people subject to the Goodman case, and the death benefit is considered a taxable gift. So you have to be careful on how it's structured. In other words, most of the time, the insured owns the policy. For estate planning purposes and business, sometimes there's somebody other than the insured that owns it. But in personal situations, most times the insured will be the owner, and the insured gets to name the owner gets to name the beneficiary. But, like I said, there could be instances where you don't want the insured to own the policy. Let's say, I don't know, they're getting some type of governmental assistance that they might be disqualified from if the government finds out that they've got an ownership interest in this policy. So they make their spouse the beneficiary. They make the spouse the owner. That's fine. If they then make the kid the beneficiary, that's the Goodman case. You've got the spouse as the owner, the other spouse as the insured, and their child as the beneficiary. The death benefit is now going to be a taxable gift to the beneficiary. You've got to have two of those have to be the same. You can't have 3 different people in those three different roles. All right? Inadvertent tax trap. Any questions on that? Want me to go on, or am
What
I
about
done?
the transfer to a life insurance trust?
What about it?
How does the gift,
Well, again, normally when a policy's in a life insurance, the question is, what about a transfer to a life insurance trust? Generally, the trust is the owner and the beneficiary, so you're not violating that. You got the insured, and then the trust is the owner, the trust is going to be the beneficiary. When the insured dies, the proceeds get paid into the trust, into the owner. You're not violating the Goodman Rule, so it's not a problem. If you were to name somebody else as the beneficiary, if you transferred it into the trust and had the trust as the owner, Howie as the insured, and your kids as the beneficiary, well, that's a problem. The trust has to be the beneficiary.
10 minutes? Or are you done? Are you good?
I'm good. I can go longer. I mean, I can go as long as you want, but I'm good right now. This is a good.
Yeah, I was gonna say, why don't we take a 10-minute break then?
Okay.
And then, because Jonathan.
Then Jonathan, okay, fine. If anybody has any questions, I'm available. Thanks for your attention.
next session, and we have Jonathan Preston, who's going to speak about estates and trusts. So you all know Jonathan. So.
It's fun. Good afternoon. Welcome back, fellow Lehigh alums especially. I'm going to go over a little bit of, this is a topic I covered for the New Jersey Bar Association Elder and Special Needs Law Symposium a week ago Monday. So when we had our speaker fall through and we were scrambling, I said, I can do this again. So this was a little more geared for lawyers, but I'm going to shift it a little bit. So my materials are pretty much the same, except it says NJCPA instead of NJSBA up here. I know we're coming from all different practice areas, so I apologize for some of you if this is a little too basic, just to lay some groundwork. Obviously, our new estate tax situation and inheritance tax. New Jersey has no estate tax anymore. Remains to be seen if it comes back. I keep hearing it's coming back, it's not coming back. Federal, we have our 11.18 million exemption. We all know that goes back to 5 million plus inflation change CPI adjustments from 2010. In 2026 that happens. But we still have the New Jersey inheritance tax to deal with. So I just want to briefly hit who that hits. Unlike the other estate taxes, not only is a spouse exempt, but children, grandchildren, great-grandchildren are all exempt. Also, stepchildren are exempt. Anyone beyond that, we're looking at Class C. Charities are exempt. They're Class E. Anyone else is either a Class C, which is sisters, brothers, a few other people, and everyone else who isn't otherwise classified is Class D. Class D gets whacked at 15% on the first 750,000, 16% big jump on everything over that. I have no idea how they came up with that. I wasn't born yet. I mean, maybe I was, but if I was born, I was very little. Howard may remember.
He wrote it. I get picked on.
Stepchildren are exempt, but step-grandchildren are not. So typical planning will say to various people, per stirpes or per capita or by representation, which means if the person you've named is not alive, it's going down to their issue. So if you've named a stepchild, say if not alive, to their issue per stirpes, or you've named a group of people that includes stepchildren and say, or per stirpes, we could have going to step-grandchildren, and they get whacked with the inheritance tax. Important exemption for the couple exemptions from the New Jersey inheritance tax is out-of-state real estate, but not out-of-state intangible property. So if you've put the Florida home, doing some planning, or some other state home, into an LLC, you've converted exempt real property into taxable intangible property for the inheritance tax. Right? I mean, the other good reasons to still do it, but just be aware you've now made this LLC, made it into an LLC membership interest. It's now subject to New Jersey inheritance tax. Right.
If it's part of your estate and you sell it, then
I'm sorry, what?
suppose the out-of-state real estate is sold and then given, the proceeds given to a Class D beneficiary.
Okay, the question was, what if the out-of-state property is sold, presumably while the person's alive, and given to it?
By the executor.
Doesn't matter.
Well,
I mean, once the person, the inheritance tax is like the estate tax. You take your snapshot at the moment of death. Transfers, good point though, transfers within 3 years of death are presumed to be, there's a presumption, that it was made in contemplation of death, and are all pulled back in for inheritance tax. Now, if they're all the Class A beneficiaries, nobody cares. But if you've given money away, you can't avoid the inheritance tax by deathbed gifts to Class C and D beneficiaries. Right? Transfers within the 3 years, pulled back in. If you can overcome that presumption, it's excluded. Right? While they were alive, they gave $10,000 to every niece and nephew when their wedding, their christening, their bar mitzvah, and their confirmation, and whatever the Hindus do. If you can show that, it doesn't matter that that was done within 3 years of death. You can show a pattern that, hey, this wasn't in contemplation of death, this was something they did over their lifetime. You can get that excluded. Life insurance to a named beneficiary is not subject to inheritance tax. So very often in my planning, I will have, they want to leave things to non-Class A beneficiaries and they own life insurance. So we get their change of beneficiary forms for the life insurance, and we name the Class C and D beneficiaries on the life insurance and bump up the shares of the other people under the will, of the Class A under the will. We're all familiar with gift taxes. We have a $15,000 annual exclusion. To the extent you go over, you use up your $11.18 million. We're familiar with the deceased spouse unused exemption amount, and that you can carry it over for federal estate tax. So let's get to the fun stuff and the income taxation of trust. In my materials, I've got the first section of the 1041. And everybody here and on the video feed, please raise your hand if you prepare 1041s. We got a bunch of people here and just 4 or 5 on the video. Okay. On box A, check all that apply for what type of 1041 this is. Decedent's estate, simple trust, complex trust, qualified disability trust, SBIT, S portion only, grantor type trust, bankruptcy estate chapter 7, bankruptcy estate chapter 11, pooled income fund. And note you can check more than one. We're really going to talk about the simple trust, the complex trust, and the grantor trust today. And how do you figure out what the hell you have when you go to prepare the return? Because it's not an easy question. All right? If you are stuck, ask the lawyer who prepared it. They ought to know. Right? They prepared it. If they don't, your client maybe should be coming to somebody else.
I have a question. A special needs trust.
We're going to get to it. Whether it's, what type of trust is it?
Yeah.
That's exactly one of the things that we are absolutely going to cover.
Okay.
And there are more than one type of special needs
Right.
trust.
That's what I wanted to
So
ask.
let's go over the basic types of trusts first. We have a revocable trust. A revocable trust can be changed or revoked by the grantor. It's ignored for income tax purposes. All right? It shouldn't even be on a 1041. It should be on the grantor's individual return as if it didn't exist, as if the trust didn't exist, not the grantor. An irrevocable trust can't be changed or revoked by the grantor. So now we need to look at what type of irrevocable trust it is. A testamentary trust is a trust created under a will. By definition, it has to be irrevocable. Right? The grantor is creating it in their will and they are now dead. The trust doesn't exist till they're dead. Can't be changed. And I sometimes I got last week from an attorney, who drafted the will, I set up this trust in the will, can you prepare the trust? No! There is no separate trust document. The trust is what the will says it is. All the terms are in the will. There's no separate document. I get that from some accountants, none here, of course. Bank officers, some occasional trust companies, life
Brokerage firms,
insurance,
yeah.
brokerage companies.
They don't understand.
They don't understand. But you should know, there is no separate trust document, it's the will. That spells out the terms of the trust. I did offer to do a trust reformation, if we can do it under the New Jersey Uniform Trust Code or go to court to reform it, to put in additional terms. I haven't heard back from him yet. An inter vivos trust just means inter vivos means during life, just means the trust was created during lifetime. Yes, you have a separate trust document. All right, so getting to our classifications, a simple trust is fairly simple. It is a trust that by its terms requires all the income to be paid out currently to the beneficiary. And the income beneficiaries are then taxed on the income of the trust. What's income of the trust? It's interest, they're actually taxed on the distributable net income. And they get a K-1 for the distributable net income. Usually, that's interest and ordinary dividends reduced by the expenses of the trust properly allocable to that income. There is a power to adjust under New Jersey law and an election you can make under New York law to treat capital gains as part of distributable net income and pass them out to the beneficiary. But normally, it's the interest and dividends reduced by the deductible expenses. And your software program should be making that calculation for you. If a simple trust allows for principal distributions and actually makes a principal distribution in that year, it is now not, you no longer check simple trust, you check complex trust for that year. You want that one again?
Yes.
If a simple trust makes a principal distribution, in the year it makes a principal distribution, it's treated as a complex trust.
And the next year we go back to simple.
And then the next year it's back to simple.
What is the income tax effect to that?
Usually
Can be.
none.
Oh, okay, even because you almost think, well, it's still.
Because you still have to pay out all the distributable net income.
But the distribution of principal does not constitute.
Correct.
Distributable
Right.
income to the beneficiary.
Right.
So you get the same
Right.
answer.
Just a very basic concept with trust taxation. A trust is taxed on its interest, dividends, capital gains, just like any other taxpayer, but it gets a deduction for the distribution of distributable net income. So it gets to deduct that income and it gets passed, and the beneficiary gets a K-1 and picks it up. In back first and then over to Steve.
What's involved if you want to elect to distribute the capital gains? What do you need to do?
Trustee sends a writing that says, I hereby elect to treat the capital gains as part of distributable net income this year.
You attach a statement to the return, or you just document it someplace?
And put it in the file.
Don't you have to have it followed, though? Doesn't there have to be some consistency?
No,
No?
not under New York law. It's an annual election. I've taken it as an email from the trustee that says I'm doing it again this year.
But can there be situations?
Sorry.
If you distribute principal, does the capital gains follow? Also, let's say you had capital gains in that year,
Not ordinarily,
not ordinary.
right. You have to actually make a power to adjust under New Jersey or make the election under New York law to include capital gains Otherwise, capital gains are taxed at the trust level, even if you've made principal distributions. There was an internet question, and then, no?
No.
Okay.
Just very quick, is there such, couldn't you have, as part of the trust agreement, could the trust agreement provide that you distribute capital gains as well?
Yes.
Okay,
If
but
the trust agreement,
if it's silent,
Correct.
then you assume everything else is just.
correct, your trust could say distribute capital gains, in which case
Very
capital
unusual, but
gains
it can happen.
would go out.
Okay.
And it can be carved out.
Yeah.
Only certain
Okay.
types.
A complex trust is any trust that's not a simple trust.
Oh, beautiful definition.
Yes.
Like 199A.
I'm gonna skip for our
Jonathan,
purposes.
Jonathan.
Yes.
Here. And usually in a complex trust, in the terms of the agreement, it uses the word discretionary distribution.
Right. It just means that the income
It's
is
up to the
not
trustee
required
of
to be
whether
paid
or
out.
not they want to distribute it out.
Correct.
If it says it's discretionary, and that's an easy way to determine when you're looking at whether or not it's simple or complex, see if the word discretionary as to income is in the trust agreement. And that's very simple. Or complex.
It's complex, actually.
And you better be careful because of the high rates that the trust ensures.
Oh, yeah.
Actually, the rates are not different than individuals. The brackets are extremely compressed. Extremely.
12,000 or something.
And we're gonna
12.5,
we're gonna get to the brackets, I hope. The other type of trust it could be, if it's not, actually not all trust, it could be simple, complex, we could have a grantor trust. A grantor trust is disregarded in a way for federal income tax purposes. All the items flow through to the grantor. The grantor does not get a K-1. It gets a grantor, the grantor gets a grantor letter which says, line by line, item by item, here's what you pick up, here's all this stuff that would normally go on the trust return, pick it up on yours. And the front page of the grantor trust return, after you fill in that top section, where you would have all the income and deductions, it says, this is a grantor trust, all items are being reported, and a letter's been given to the grantor. And that's what it says, and then the trustee signs it, and off it goes.
Jonathan, most of the people that are sitting here right now, we have clients that come in and they listen to one of these television evangelists who tell you, let's avoid probate and put it into an irrevocable trust, and they do it and they put their house, or they bring in their children to put on the deed. How are these trusts classified?
Usually, if you're looking at just probate avoidance, it's a revocable trust. And it can use the person's social security number as its ID number. If the bank gives you a hard time on using the social security number, take the first two numbers of the social security number, put in a dash, and put the rest of the social security number, and they're happy. That really works. Whatever gets it done sometimes.
And then again, if you're gonna have one of these living revocable trusts, which are very typical in like Florida or these retirement states, make sure when your attorney sits down with you, make sure you follow up and move all your assets into the title of the trust.
Right. I don't want to get too off into revocable trusts. Just in New Jersey, we generally don't use them because probate is simple, easy, and very inexpensive.
Right.
I do want to get into grantor trusts. To understand grantor trusts is difficult. You can't always tell easily by looking at the trust. It depends who the trustees are, their relationship to the grantor, and what powers they have. And then you can always have all that be good for a non-grantor trust, and you slip in a provision on page 25 in Article 13G that makes it a grantor trust. So I won't get into a few of the rules for grantor trusts. And by the way, in tax season, if any of you have issues and you can't get a hold of the attorney who did this, or the attorney who did this doesn't know what the hell they did, call me, shoot me a copy of the trust. I'll spend 10, 15 minutes to zip through it. I can usually tell and give you a quick answer. Is it a grantor or non-grantor trust? Okay, I know the provisions I'm looking for in there, and generally where they're buried. I know where the bodies are. Do you have an adverse party? Two definitions you need to know with grantor trusts are adverse parties, three definitions, non-adverse party, and a related or subordinate party. An adverse party is someone whose interest is adverse to the grantors. All right? If they have an interest, someone has discretion in the trust that's, adverse to the beneficiaries. If a trustee, let's say dad sets up the trust, we've got son and daughter as the beneficiaries. Son is the trustee, and he has the discretion, let's say it's daughter, for disabled daughter's benefit for life, and what's left goes to son, or if son's not alive, son's issue. And son is the trustee. Anything the son elects to distribute to the daughter is less that's there for him. That's an adverse interest. All right? In the code section, the definition of a non-adverse party. For purposes of this subpart, the term non-adverse party means any person who is not an adverse party. Right? So if they have a beneficial interest that's contrary to that of the beneficiaries that they can exercise discretion for, that's an adverse interest. A related or subordinate party is someone that the grantor basically can exercise some control over or has a family relationship with. Grantor's spouse, if they're living with the grantor. Father, mother, issue, brother, sister, an employee of the grantor, a corporation or any employee of a corporation in which the stock holdings of the grantor and the trust are significant from the viewpoint of voting control, a subordinate employee of a corporation in which the grantor is an executive. Those are related or subordinate parties. Why do we care? Because any powers held by the related or subordinate party are considered held by the grantor. So if we're looking at what controls the grantor still has over this trust to determine if it's a grantor trust, and we've got a related or subordinate party as a trustee, all the trustee powers are assumed held by the grantor. I'm going to skip foreign rules. So, what makes it a grantor trust? If the grantor has a reversionary interest that exceeds 5%, it's a grantor trust. Typical situation, qualified personal residence trust, grantor retained annuity trust, grantor retained income trust. These are grantor trusts. One thing that will be ignored is if the grantor has a right to get the property, they've set up a trust for their child or a grandchild, and they've put in a provision that if the child or grandchild dies before age 21, it comes back to the grantor. That's ignored. if the grantor has the power to control the beneficial enjoyment of the trust, it's a grantor trust. Grantor puts the money into a trust and says it's for the benefit of my issue, but I have discretion to decide, or a related or subordinate party has discretion to decide when they get it, or I can change the amounts that they get. If there's discretionary income, distribution of income, that's control. They can distribute or hold it till later. They've retained control over the beneficial enjoyment. It makes it a grantor trust. Lots of various exceptions. The code sections are in the materials that are posted online. Various administrative powers. This is typically what we do if we want to have, and the income tax rules are different than the estate tax rules. So very often we want to have a grantor trust for income tax purposes, but keep it out of the estate for estate tax purposes. When we're doing that, we're usually looking at the Section 675 administrative powers to make it a grantor trust, being careful not to have non-adverse parties or related or subordinate parties as trustees. If they can deal with less than adequate, power to deal with the trust for less than adequate and full consideration. If they can borrow without adequate interest or security. They may still have to give a promissory note, but this trust says they can borrow without giving security. That's enough to make it a grantor trust. If they can exercise any power in a non-fiduciary capacity, that makes it a grantor trust. Obviously, if they have the power to revoke it, as to all or any portion of the trust, it would be a grantor trust. If any of the income can be used for the benefit of the grantor, it's in grantor trust. Very often in Medicaid planning, we will do a transfer of assets of the Medicaid applicants, assets to an income-only trust. Some states that works, some it doesn't. But if the income is payable to the grantor and they can still never touch the corpus, it's a grantor trust. There are a few rules where skip where a person other than the grantor can be treated as a substantial owner. I think somewhere in here I missed my favorite provision. Skipping through my certain foreign trusts. My favorite provision to use when I'm drafting is the power to substitute assets of equal value. If the grantor in a non-fiduciary capacity can trade assets, his own assets for trust assets, even though it's an equal fair market value exchange, that makes it a grantor trust. Now, actually, in our planning now, especially as we're very focused on income tax planning, that's an excellent clause to have in your trust, because if we now have, if we've got a grantor trust that's excluded for estate tax purposes, and we now have appreciated assets in the grantor trust, we can swap cash for the appreciated assets, get the appreciated assets back into the name of the grantor, still have an equal value of assets in the trust, and now the grantor dies owning the appreciated assets and we get our step up in basis. Whereas if we just left them in the trust, we're going to get the carryover basis. Yes?
As a tax information, in a grantor trust, you get the letter that shows that you were taxed on those assets, that income. that income does not have to be distributed.
Correct.
The grantor is paying, so it's an income tax benefit that when a grantor has value, he wants to protect the value of what he's put into the trust, pay the tax
In a
on.
way,
But
it's-
he's the one using his money versus the trust funds to pay the
Correct.
tax on the income. Also on a
That's
complex,
it's effectively letting the trust go income tax free or
Right.
making additional contributions to the
then on a
trust.
complex trust, I think you're given 2.5 months to distribute out to the beneficiary.
Yes.
It gives you the chance to do the proper accounting, but a time to get it out and that beneficiary is still taxed on it. Where in a simple trust, you're basically is telling you quarterly or monthly distribution, but you're still given 2.5 months in order to get that money out, that income out.
Right. Yes, you have 75 days after the close of the trust year
Right.
to elect to make a distribution. Then you can elect to treat it as having been made in the prior taxable year.
And it's 75 days, it's
Right,
not 2.5 months.
75 days, correct.
Jonathan, are there times when you get a step up in the grantor trust and times when you don't?
Only if you have estate tax inclusion for the grantor trust that it's pulled back into the taxable estate. Otherwise, you don't.
Right.
Usually, we don't, because we're usually planning with grantor trusts not to have estate tax inclusion.
So what happens with like the Florida trusts?
I don't know what a Florida trust is.
The trust that everybody sets up in Florida, don't they
The,
get?
well, that's a revocable,
That's a
that is a revocable trust, and we covered that, that's as if you did, the trust didn't exist,
Right.
except for avoiding probate.
Excuse me, is there any timing on the swap? Like,
No?
you can do it like close to death?
Deathbed, yeah, you could do it deathbed,
And
sure.
they inherit the time, the ownership time, so it's long-term, carries over?
Yes.
Yeah.
Stepped
Well,
up with all
okay,
trust.
any assets you inherit from a decedent for capital gains purposes is considered long-term capital gain. Person dies January 5, you sell it January 6, it's long-term capital gain. And there's a box to check that it's inherited property. And on your purchase date, you would actually put in the date of death, and there's a box to check that it's inherited property, and it gives it long-term capital gain treatment.
Jonathan?
Yeah, back
So
and then
using-
Howard.
Using that example, so if the decedent buys it on December 28th, dies on January 5th, you get it on January 5th and it's long-term.
Yes,
As long as it's in his estate.
As long as it's in the estate.
as long as it's in the taxable estate, right. Yes. Oh, sorry, Howard was first.
Yes. Another question that we see lately is, when do you not get the $250,000? We get a lot of questions like that on the trust.
Oh, for the principal home exclusion?
Principal home exclusion.
I'll see if I can get to it.
Okay.
If you have a situation where the trust has assets in the stock market, for example, and the valuation goes up from the date that it goes in trust, who has the increase in value? Is it the income beneficiary or it's the estate beneficiary?
It's the principal beneficiary, not the income beneficiary. Capital gains are principal. How much time do I have?
You have about 10 minutes.
Shit.
Where's the FCC?
You're gonna cover the whole 199A.
I'll give you 15, how's that?
Income tax consideration. Right, we use a couple different trusts in disability planning. The most typical is what's called a D4A trust, or a sole benefit trust. We're putting money in for a disabled beneficiary. It protects the assets from, and this we would use where the disabled beneficiary has funds. Because the D4A or sole benefit trust must have one of two requirements, either an actuarially sound annuity payout to the special needs beneficiary, which means they're getting a stream of income, which we generally don't want, or we have to have a government payback at the end for any Medicaid benefits they've received as the primary beneficiary. So if this is allowed, if the disabled individual gets assets, they can self-fund this trust. So this is really designed for the disabled beneficiary's own benefit. Their own funds are going in. They are a discretionary beneficiary, and in applying the grantor trust rules to see if they have a reversionary interest, we assume maximum discretion will be used in favor of the grantor. So we have 100% reversionary interest, and it's a grantor trust.
What about special needs trusts where,
That's next.
oh, all right. This was, you were describing a different kind of special needs trust.
Well, that is a type of special needs trust.
Yeah,
All right.
exactly.
Now, we have a third party, special needs or supplemental benefits trust. Someone else is putting the money in for the disabled individual. Right? Because we have a disabled individual and we are trying to preserve the ability to get government benefits, these are always discretionary, with language that's supposed to be used to supplement, not supplant, government benefits. Since it's always discretionary, we have a complex trust. That answers the question?
So let me just repeat it so I make sure I understand what you just said.
Okay.
If the beneficiary, if the distributions are only to supplement the governmental programs,
Right.
and at the end of the day, a third party is the ultimate beneficiary of the principal upon the death of the...
Right, because unlike the
That makes-
first party trust, we don't have that requirement for a
Right.
government payback. We can have the money,
It's not paid
whatever's
back,
left,
and
going wherever we
The grantor's
want.
not getting it back, the assets are going in. That's a complex trust.
Correct. Right, because the trustee is not required to distribute the income.
Correct. Okay.
Right, to the extent they actually make distributions, they will get a deduction for the distributable net income. Right, and it can be distributions to or for the benefit of the beneficiary.
But I thought let's take a situation where the beneficiary is, they paid for an aide to go with the beneficiary on a vacation.
Okay?
In effect, you made a distribution by paying the
Correct.
aide.
And that's treated for tax purposes as a distribution to the beneficiary.
Wouldn't that counteract the purpose of the of the trust? Because the idea is not to have the beneficiary have any income in order to maintain the
Why
government.
would that?
Because you want to maintain the fact that the person can get the government
Right, so
beneficiaries.
for tax purposes, it's considered as a distribution to the beneficiary,
So then the
not for benefit purposes.
But that means the beneficiary is going to have to file a tax return.
Yes.
I see.
Okay.
I thought the idea was the trust absorbs the expense and doesn't get the distribution deduction and just pays the tax.
Why? There's no reason
Well,
to do that.
because then you make
Because
this-
you've got
then
a
you make this-
disabled beneficiary at extremely low brackets. Why would you want that?
So then you're making it a simple trust, right?
No, it's
Still
complex
complex.
because the distributions are all discretionary.
I see.
Right, simple trust has a mandatory payout all income to beneficiaries.
Got it.
Okay. I'm not yelling, I'm talking loud for the tape in the back of the room, and the back of the room. So why do we want a grantor trust? I did put in my materials tax brackets. They are incredibly compacted. We hit the top rate of 37% for amounts in income in excess of $12,500. Our top 20% capital gains rate starts at capital gains of $12,600. If we had a single taxpayer, we'd be hitting our capital gains rate of 20% at, where the hell did I have it? A hell of a lot more than that. 38,600. Okay. Estate tax considerations of some typical trusts we use. We have, actually, maybe we'll skip the estate tax because we're at a good stopping point. Howard, what was your question? I'll cover that and then we'll, the home sale
we get
exclusion.
people put homes into trusts.
Okay. There are a couple.
People put them into LLCs. People they listen to whatever her name is, all right, etc. When do you lose the $250,000? Because
when you're no longer considered for tax purposes as the owner.
Right.
If you have a single member LLC that's a disregarded entity, you're still considered as the taxpayer.
Right.
New Jersey, married couples, in community property states, a husband and wife can own the LLC and it's still considered a disregarded entity. We are not a community property state. If we have a husband and wife owning an LLC, it's a partnership, unless you've made another election, and it cannot be a single member disregarded LLC. Some of the typical planning devices we use for Medicaid planning or with special needs planning would be to make a transfer of the home by the senior or the parent and retain a life estate.
But the life estate has a value, and this is where people are missing.
Correct. Now, if there is a sale during, while the person is alive, you've done the I've put the house in kept a life estate, and my kids are the remaindermen, and I sell the house while I'm alive, we split the proceeds. You calculate the value of the life estate, and I get that, and I get my home sale exclusion for it. And the kids, it's not their principal residence, they get hit with a capital gain. Right? Sometimes we're doing, I've seen other attorneys, not me, do transfers to a trust that's that's excluded from the individual's estate, but they've kept, let's say, a right in the trust to use and occupy the home. But then they're in a nursing home, and they're no longer using and occupying the home. A use and occupancy ends when you no longer use and occupy it. So now, there's no pullback into the estate anymore, and you lose your step up in basis. I don't like using use and occupancies. There's some issues with estate recovery or non-estate recovery. On life estates, New Jersey does not impose estate recovery on life estates. Estate recovery is you've gotten Medicaid benefits during your life, we have excluded assets, but on your death, we've let you keep these assets, but on your death, and we've paid for you through the public fund, we want to be repaid. New Jersey does not have estate recovery on life estates. So we avoid estate recovery, we can get Medicaid qualification, and the money is, and we get our step up in basis, because a transfer with a retained interest that does not in fact end before end before death, is pulled back into your estate under 2036, and we want the pullback into the estate here to get the step up in basis. If we've blown that, the kids inherit it, and mom and dad bought the thing for $50,000 and now it's being sold for $600,000, they've got a $550,000 capital gain, and you've got some very unhappy children of clients who under New Jersey law could actually sue you. What else do we do? The other thing to be aware of when you're doing the life estates, and I started including this in my life estate deeds after I saw it blow up with another attorney's planning. Thank God it wasn't mine, but it could have been at this point, at that point back in time. They didn't specify in the deed how to calculate the value of the life estate. And what if mom and dad want to do the life estate, but they're thinking maybe they'll move to Florida in 5 years? Well, you have that cash out mandatory on the life estate. So if they're moving to Florida soon, you may not want to do that. In this one, Dad, the widower, named son is the remainder beneficiary on the remainder interest on the life estate. Dad wanted to buy a new home. Son said, not only am I not going along with it, I want to calculate the value of the life estate under the IRS tables, which gives me 90% and you 10%, instead of the Medicaid tables, which would give you 40, which would give Dad 40% and Son 60%. And this was going to litigation. I don't know if they settled eventually, but Son turned out to be a real shit, and sorry, a real bad kid, and hosed over Dad. So yeah, something to be careful of, and I always look at it as, look, we're doing this for Medicaid planning. Not only would Dad not get only that 10%, when you make this transfer of the life estate, we have a 5-year look back for Medicaid planning purposes. The value of that remainder interest under the Medicaid tables is considered a transfer on the date of the deed. So you now have either, if you apply for Medicaid within 5 years, that's a penalized transfer. So you got to wait out the 5 years or take the penalty period. If Son ended up getting on the sale more than the value that Medicaid said he was entitled to, that's going to be another penalized transfer. Yes, some questions? Yes.
Just another point to add, Jonathan, you brought up a lot of different reasons for having trust, but in today's day and age with divorces and second marriages, etc., trusts are very important when you have what we call blended marriages, because you want to be able to protect the assets for both spouses and their children, and not the surviving spouse coming into the assets of that trust that could benefit that surviving spouse and the surviving spouse's family and ignore
yes,
the deceased family.
Marital trusts are a whole separate credit.
Right.
There's
But
good
it's a
reasons
very
to
important
still
reason to
use what we would typically think of as a bypass trust or a marital trust in non-tax situations, especially with blended marriages. You know, give the second spouse some access to it, but preserve the principal to the extent it's not used for the children of the first marriage. And there are some drafting things that lawyer can do to make that easier. One of the things I like to do with that is, because we've got a remainder interest and an income interest typically, I like to use a unitrust format where the surviving spouse doesn't get the income but gets a 4% payout every year. Calculate the value on December 31 and we get a percentage payout. Now everybody's investment interests are aligned and they're not fighting with the broker. Invest in junk bonds, invest in growth stock. Right. Everybody says let's get total return, because as the total return goes up, the 4% payout goes up and the remainder interest goes up. And you got to be careful with who you're naming as trustees and what the discretion is. I think I'm over time by a bit.
It's not way over, no, so, I mean, it's 4:20.
You get time and a half for
You get
the overtime. And then you get
Yeah,
accrued,
it's a half hour for every 30 hours.
and accrued sick pay.
Let's hear your cough.
So if there are any other questions, my contact information is on the materials which are all on the website and at the very top of the page, making it very easy to see.
Thank you, Jonathan. That concludes our meeting. Our next meeting is in the middle of December, so I won't see you before Thanksgiving, so have a happy Thanksgiving, everybody. And
Did you answer that question? Tell them to call me.
I sent it back to Pam and told him to email you.
You guys confused.
I didn't want to bring it up here, so